Hello, I'm Ken Shinoda, a portfolio manager and one of the original founders of DoubleLine. I'd like to wish you all a warm welcome to DoubleLine's Channel 11 News. This is the inaugural episode of our financial YouTube channel, where we hope to bring you our market insights, commentary, along with a few laughs along the way. Before we talk markets, I'd like to first wish everyone and their families the best health and happiness during these challenging times. Well, what a year 2020 has been. The first quarter of 2020 was the worst quarter for the S&P 500 since 1938, falling over 19%. March Madness, which has left many with post-traumatic stress disorder, was the worst monthly performance for U.S. equities since 2008 during the heart of the global financial crisis. With a wild swing of investor sentiment during the second quarter, major equity indices booked their best performance in more than 20 years, with the Dow up 18%, S&P up 20%, and NASDAQ up a remarkable 30%. The bond market experienced a similar recovery, with the U.S. corporate bonds surging over 8% during the quarter, retracing much of the declines from previous months. As I look back on the dark days of March, two major forces pushed asset prices into their March freefall. A massive supply-demand imbalance, as we saw what seemed like never-ending selling from all types of investors, together with the then unknown economic impact from the COVID-19 pandemic. In March, panicked investors sat wondering what was going to happen to corporate revenues, consumer income and spending, and what that meant for markets. At the time, it felt like the only thing that could stop the vicious cycle of falling prices was an aggressive policy response, which was exactly what the market got. It started with QE4 on a Monday and ended with QE infinity a week later. The Fed first addressed the supply-demand imbalance with a tidal wave of monetary stimulus, which helped slow fund outflows and restore investor confidence. Additionally, the Fed's consistent messaging made markets believe that it's prepared to remain accommodative and use its full range of policy tools aggressively if needed. It's no surprise that the "Don't Fight the Fed" mantra is back in action, hashtag BTFD. The fiscal stimulus response from Washington was no less ambitious, with both Republicans and Democrats finally rediscovering the long-forgotten art of bipartisan collaboration. Together, they passed the CARES Act along with other legislation, which collectively provided trillions of dollars of federal support to individuals, corporations, and small business, some more effective than others, as we've seen since. The stimulus has calmed markets long enough to allow the effects to show themselves in data, both economic and borrower performance related, which has tended to actually show surprising resilience in the behavior of certain businesses and consumers. Specifically, defaults and delinquencies in many sectors of the debt markets have not been as pronounced as originally expected, which has likely helped fuel the risk rally that we've seen continue through July. While the market's recovery has been broad in scope, the current environment includes both winners and losers, not only as a function of the assets the Fed has chosen to support and not support through its various programs, but also the nature and strength of the businesses and borrowers impacted by the pandemic. This stark divergence is clearly seen when comparing the tech-heavy NASDAQ, up 21% year-to-date, and the industrial-focused Dow Jones, still down over 6%. This dynamic is also apparent on a more personal level, where a closer look at the unemployment picture reveals that lower-wage workers have been disproportionately impacted as a result of large-scale shutdowns in retail, hospitality, and leisure-related businesses. So here we are, over halfway through the year, in the dog days of summer. U.S. interest rates are now largely at record lows. Risk assets have recovered dramatically as a result of the historic stimulus we've witnessed this year. In this environment, how should we be thinking about markets and our asset allocation on a go-forward basis? To help me answer this question, I'm pleased to welcome our special guest, Jeff Sherman, DoubleLine Deputy CIO, host of the Sherman Show podcast, and a good friend of mine, to our inaugural Channel 11 YouTube show. Welcome, Jeff. Thanks for joining us, Jeff. Good to have you on. Yeah. You know, we've seen some big moves in markets, rates at historic lows, risk assets having huge rallies off the March lows. And some can say there's a little bit of disconnect between where markets are and then where we see the economy.
Yeah.
What are your thoughts on that?
Well, definitely there's a big disconnect. We saw the worst GDP print in post-World War II era coming out of the U.S., an annualized 32.5% rate or so. I say or so because at that point it really doesn't matter. If you're down 30, down 32, 33, what does it matter? But I think you can say that we had to shut the economy down, or we chose to shut it down, and there needed to be some form of stimulus. There needed to be some form of replacing those payments. So we've been discussing a lot, is it stimulus? Is it really just a transfer payment and essentially taking on debt to kind of plug the gap? I'm in the latter camp, of course. But it's not shocking to see risk markets be fueled at this point. You have ultra low rates. You have a Fed that's committed to staying low. And in the last press conference, Mr. Powell came out, added another not thinking about it, right? He said they're not even thinking about raising rates. And so I think you have this accommodation. You also have, there's winners and losers in this economy. And what you're seeing in a lot of risk assets is the winners, the things that are benefiting from this part of the market or this dynamic of the economy are the ones that are winning. So there's still challenges. I'm sure we'll talk about that.
Sure.
But again, remember that the market is not in sync with the economy. Think about 2018. Market did well until the fourth quarter, right? Then all of a sudden, earnings kind of didn't really do much in 18. The market looked forward, had that strong return, but then in 19, earnings came back, looked strong, and the market didn't do much. So you have this dynamic here where the market is never in sync with the economy. It's always a forward-looking mechanism. So are risk assets a little ahead of themselves, perhaps? And I think what you're going to see is that as we move on to this next phase, whether it's the fourth quarter or really going the first half of next year, is that do we continue doing these transfer payments, continue adding stimulus, or are we going to let the economy stand on its own? And I think that's what the market's digesting right now.
Yep. Well, let's start cycling through the different parts of the capital markets, because investors now are, we've seen big moves and they're going to wonder, okay, what do I do now, right? And, we're big a bond shop here. So why don't we start with the bond market? Rates are at historic lows. How is the investor positioned for that? Like, should they be long duration? Are rates going to zero? Are they going negative? It sure seems like the Fed doesn't want rates to go negative, right?
Right. Well, I think that's the biggest thing to think about. So, the first thing you want is the DeLorean. We always talk about hit 88, go back to the future, and buy the things that worked. And that's what a lot of investors tend to do, is they tend to chase markets. They look at what has worked. And I think what you're asking about is that prospective side, is that can the interest rate component help you in this market? And so one thing about it is we know that buying U.S. Treasuries you're not going to get rich off of yields at this point. And the real yield, once you subtract or adjust for inflation, is actually negative. So you can expect if we hold that Treasury today, you're likely to lose purchasing power. So if you're going to have a big allocation of Treasuries, and I would never say don't own zero, but if you're going to have a big allocation, the thing you need to be betting on is either that we're going to have deflation, that is the lack of inflation or a negative inflation rate, or you think that rates are going to go negative. Because let's just do some simple math on like the 10-year today. Yields are in 50 basis point range, call it 55 or so, between 50 and 55. Well, if you look at the duration of that asset, let's just say that the 10-year goes to zero, right? Well, essentially what you can expect in price appreciation from that math is about a 4.5% gain. So if you say you get the 50 basis points or 0.5% of carry of the year, and that's what happens, you get a 5% return. Not a bad return, right? Especially in this low environment. But then again, now you have a zero yielding asset on a go-forward basis. So to us, it just doesn't have a lot of power in the portfolio today unless rates are to go negative, because you need that price appreciation to really help you make money, especially in excess of inflation. So a long-winded saying is that I think that Treasuries don't have the power in your portfolio that they have historically to offset some of that risk. And then the other component you have to think about is, what if rates do indeed go up? So we know fiscal stimulus, more of it's coming, right? We know that Congress is still going back and forth. I read the headlines today saying
deficits are skyrocketing, right?
Skyrocketing, and there's no semblance of the Tea Party or the deficit hawks, as they called them. And when I say that, what I'm getting at is that they don't really seem to care about deficits at this point. And I had a guest on the podcast a few weeks ago that said, well, maybe indeed what will happen is that if there's a change in leadership, all of a sudden deficit hawks will show up. Like, that's to be seen. But we're starting with the baseline of at least $1 trillion in spending, and that's $1 trillion deficit incremental at this point. Remember, we already did 2.2 trillion in the CARES Act. The Democrats had proposed at the House a $3 trillion deficit. So they meet in the middle somewhere. Most pundits think it's going to be at least $1.5 trillion. So that's more money that's going to be slushing around the system. That's another reason probably risk assets are looking forward to that as well. So they're already front running that idea. But what happens if the Fed doesn't buy those? What happens? Right now we have this dependency. It's a codependent relationship between the Fed and the markets at this stage. And so what I would be concerned about is that what happens if they don't go out and buy all of those treasuries? We need to find a buyer. So we know supply and demand means if there's more supply, less demand, and similar demand, prices should go down, meaning yields up. So I just think there's asymmetry out there. We don't expect rates to go up in a meaningful manner. But if you start to see some semblance of inflation, let's say, you'd see it in gold prices. Today's a record day. We had $2,000 an ounce in the gold market. Yep. So if you think there is going to be some form of inflation, then yield should probably be a little bit higher. And that could put some pressure. And remember, the Fed can change its mind. So anyway.
So it seems like there's less upside and more downside in bonds, given that if zero is the floor potentially on rates, given the Fed doesn't want to take things negative, that you have about 5 points of upside and maybe infinite downside.
A lot of downside, but also remember, when you're saying bonds too, you mean treasuries.
That's right.
Right? And so there's a lot of different bonds to buy, but the risk-free asset or the thing that should help you in crisis, it's already helped you. So if you bought these long duration assets coming in the year, wish we'd owned more and wish we'd have had that view with the benefit of hindsight. But if you'd have done that, you're up at 20, 25% year to date. So take your victory lap, right? There's nothing wrong with doing that. And again, if you don't like risk, you don't have to buy it. You can also hold cash. Cash is going to give you zero, but
it doesn't go down in price.
It doesn't go down in price. And think about it, 50 basis points, it's not going to change your retirement strategy.
Yeah,
right?
So maybe it's just having less risk in the portfolio, not necessarily needing that duration pop.
Right, that's exactly right. That's exactly right. So I think that, it does take a different playbook to think about this today. You can't just go out to the old Markowitz textbook and say, okay, well, stocks go down, bonds will go up. It could happen, but there's a lot less potential for that in the future right now.
Okay. Well, let's move on to credit. We've seen a big rally in credit. Almost all credit's up: corporate bonds, high yield, bank loans, securitized credit. One of the things that we look at is the spread between the triple Bs and the double Bs in the corporate space. I know everyone thinks that the markets run up a lot, but I feel like the market's still pricing in some risk premium. I mean, the market's saying that, okay, well, these double Bs are riskier than these triple Bs. So the spread you're getting paid to own some riskier credit is still somewhat attractive if you look at history.
Yeah.
I mean, it's not as cheap as March.
No, nothing is. And it was hard to put money to work to March, as you know. I mean, even if you wanted to trade securities, it's very difficult to do so because people don't want to sell at those fire sale prices, even though, and you only really get people at their mercy at that point. But also remember, as you point out, historical spreads, they're kind of average on the corporate bond market. But if you adjust for credit quality, probably not as much. So we were looking at this at month end, which was last Friday. And what we saw there was that the, kind of the double A market, the single A market yields about 150. That's not going to get you rich either. That's barely above the inflation rate right now. But the triple B segment yields about 225. So when you blend all together, because of the heavy weight in triple Bs, what you find is the corporate bond market does yield inside of 2 today.
Yep.
Right? But you can be selective in there. You can buy some names at the lower end of that quality spectrum and still get something. And there's nothing wrong with owning a piece of that. I'd rather own a piece of that, right, and know I'm taking the risk than buy some double A that's going to get downgraded that I don't think had risk. But you talk about the double B market. And the double B is the highest quality of the below investment grade market. And the spread between that and triple Bs is wide by historical standards, but not significantly. And what you've seen is the high yield investor has really stepped into that double B market. There's been some fallen angels, things that were downgraded, but also what's happened within the double B market is that people who buy high yield say, I'm going to hide in the highest quality. But this is a quintessential example of what happens after a risk sell-off, right? Everything goes down. The highest quality within the cohort tends to go up first. But what you're not seeing in the high yield market, as well as the loan market today, is that triple C rated, the lowest kind of risk, the triple Cs and lower, really rally. And these are the things that are exposed to the COVID crisis, right? Hospitality, leisure, things that were problematic, gaming, things that were problematic before, retail. So you see these similar types of behavior there, but it is not this broad risk rally. And we could also talk about that in the equity market. You have a tech rally, right? Tech is massively beneficial from the pandemic, But when you look at it, you're not seeing broad base. So if you look at, let's say, for instance, the equally weighted S&P, it's down for the year. But you look at the NASDAQ, it's up like 21% or so.
Yep.
So there is this have and have not across things. So I think it's more important than ever to look at and be discerning with credit, look at what's there. But at this stage right now, especially if we get another fiscal package, you put money in people's hands. It is supportive of the U.S. economy right now. Is it long-term? The tenability, is it there? I don't believe so. But for the stopgap for now, I can see why risk markets continue to kind of grind tighter.
So it sounds like it's all about security selection. It's all about doing the dirty work and looking under the hood, and that some of the higher quality assets have run up a lot. And maybe the place to find opportunities, if you want to take the risk, and you got to acknowledge that it is risky, is in some of these triple Cs in the corporate market, in some of these parts of, let's say, the securitized market where there's more concern related around COVID and the economic uncertainty. I mean, you have to take that kind of risk to get paid any yield, but maybe you can take some prudent risks out there.
Right. And remember, when you're talking about this, there's nothing wrong with having some exposure to triple Cs. It's all about sizing, right? So you don't put all of your portfolio in the trade. To be exposed to something that's a hotel-related asset, you understand that's risky. Everyone knows it's risky. So the thing is, you're not going to get blindsided by risk there. It's priced for it, right? So I think that's the thing that's been the most frustrating, I think, in the market the last few months, is that what you see is this, what people would call a blind risk rally, but where it started was with the assets that the Fed had supported. Yeah. And part of these COVID-related assets are not being supported through these Fed programs. And so to us, when we talk about price discovery, the price of risk, and I mean, I remember the conversation we had back in April when we're talking about the mortgage market, right? You're saying, look, we can stress these bonds to a 10, 15, 20% house price depreciation, and we're going to get our money back. And that stuff yields 9 at the time, right? Yeah. And we're looking at corporate bonds and say, wait a sec, I could take default risk. There's this massive issuance, and I get paid 3? I mean, there's a disconnect there. Now, obviously, those spreads have tightened. Yields have come in significantly in the mortgage market, too, because people realize that's a massive mispricing. But when you look at these markets that aren't supported, I would argue that today, that's the price of risk, right? Because you don't have an artificial bid or an artificial person buying and propping up assets. So it is very challenging. And then what you also have is people that don't look at the fundamentals day in, day out, and are just saying, look, corporate bonds, they yield 2, great. 2 is better than 50 basis points on the treasury, so let me just buy it, right? And they look at what's happened in the last few months, it's up, off the bottoms, you're up 20+%. But remember, high yield is barely positive year to date. Loans are kind of on that cusp. So it isn't just this broad risk rally. There's been a rally off the bottom. But in general, you still see some markets that are down year to date.
Yeah, and moving along to equities. So it sounds like in credit, there's still opportunities. You just don't. The chase the Fed trade is perhaps over. So look at parts of the market that didn't have that Fed support, that have lagged. As long as the manager can do the right security selection and underwriting. And then when you go to the equity markets, you see this theme too, and I touched upon it earlier, is this theme of winners and losers, and you can see it. Tech versus the broad basket of the S&P. You can see it with U.S. versus emerging markets. You can see it with the U.S. versus the rest of the world. So the U.S. has run up. As an investor, am I decreasing my U.S. equity exposure?
Well, I think if you're going to stay with the same level, you got to think about, do you want to own so much tech, right? At the end of it, I mean, you talk about, I said the NASDAQ was up like almost 22% as of today on a year-to-date basis. Year-to-date, not off the lows, right? Year-to-date. It's becoming a bigger and bigger piece of the index. That's why I look at like the equally weighted. You look at value stocks. So there's other things to do within equities. And remember, you don't have to buy the S&P, right? You don't have to go and make this big bet on technology. So the U.S. has been a benefactor. Technology is good. Technology is what kind of helps replace productivity and the likes. And so the reason the U.S. stock market has done well is because technology has been the sector to really be in. But we know that there are cycles, right? And so you have to ask yourself, do you think the tech train will continue? And that's, I like the alliteration, right? Tech train. Yeah. But as we look across it, look, the really only laggard in the S&P year to date, or especially if you look at it again last month, is energy, right? Do you want to be chasing the energy sector? Probably not at this stage, right? Where there's some demand issues, and obviously there's a huge glut of supply there. So when you look at it, I think what you have to think about is, are there other things that will be benefactors as we go forward? And you'll see rotation. The obvious thing was to buy the things that are going to benefit from us working remotely, right? We're using technology today.
Zoom.
Yeah, the Zooms, you've seen, I think that people bought the wrong stock when there was like a Zoom something that people just started buying. They didn't realize it wasn't the actual technology company. So you got to be careful too. But never in my career, and a lot of people say, have you ever seen stocks that declare bankruptcy go up? Yeah. Right? So there seems to be a marginal
no longer
player.
BTFD, it's by the bankrupt company.
Yeah,
right?
Didn't we say that BTBK or something like that, right? So by the bankrupts. And so what you've seen, though, too, is the amount of accounts. And people blame Robinhood and say, okay, the Robinhood, and I'll give kudos.
But also Chase is opening accounts, and TD Ameritrade's opening accounts, and they're opening everywhere, right?
Everywhere. Schwab, Fidelity. But I'll give a hat tip to Jim Bianco, who said this, too, is that Robinhood really got a good brand out of this because they opened the API to their data platform. So you could see the ownership of stocks. And so they got this great brand behind it. It's a brilliant marketing tool where Schwab, TD, Fidelity doesn't give you that access. But you look at brokerage accounts, they're up massive. Look, people were home. We had talked about this, in our virtual trading desk, is that people don't have sports to gamble on. There's stuff that people want to do. They got this new stimulus check. Hey, you know what? It's free money. Let me play a little bit with it. And so they've had some successes too. So can these $1,200 checks, drive the market in the long run? Absolutely not. But there has been a different type of behavior. And so when you look at the V-shape idea of the recovery, it is an asset price, as it is. And the Fed is excited about that. But also, if you listen to Mr. Powell talk, the thing I took away from the last press conference, he emphasized it's the path of the virus. And we're not out of the woods yet. We sit here in California. We just had crossed 500,000 cases here. We have our death rate is still relatively high. It doesn't look like we have any of this under control yet. Yeah. So I think the other question is, what happens next? Remember, the markets trade on marginal dollars, right? So if we're going to continue to press on in risk and assets, what has to happen is more money needs to come in, right? Which means
that seems to be a lot of, and I hate the cash on the sidelines joke, but if you look at the savings rate spiked, a lot of money in money market accounts.
Yeah.
And so
it's amazing that we had a recession. This is the first time, again, I always use post-World War II because it's kind of the way that we look at the economy, but it's the first time you've ever seen in the onset of a recession, incomes go up and saving rates go up. Then you got the Fed data, and it's like
all the money. It's free money.
It's
stimulus
free money.
Checks.
It's free money. And so for all of you proponents of MMT out there, you saw it. This is what it can do to things. And so look, we just paid taxes a couple of weeks ago. I've still said this all along, is that if you're going to do MMT, why do we collect taxes? Yeah. What's the point? Let's just see how long we do it. But we know that's not tenable in the long run. So we'll have to see. We'll see if there's any deficit hawks coming back. But look, if Congress doesn't act and help these people in the lower income cohort that we forced out of jobs because we closed the economy down, and a lot of this stuff isn't going to come back. So that's going to cause a problem. We need to plug that gap. But remember, there's the next gap in a couple of months, because what happens when corporate America can't stimulate, they can't increase their profitability on the revenue side? You got to do it on the cost cutting. You're already seen this. There's announcement of job layoffs.
That's when the white collar job losses.
Right, and it goes up, and that's when you get a bigger problem. And then the question becomes, well, do we throw $3 trillion at it? $4 trillion? What do we do? And so the market's looking beyond that today.
Yeah. So I mean, on that note, let's move to commodities, because we just talked about money printing. So in a world of money printing and a world of higher inflation expectations, as we've seen recently, which is why real yields have collapsed. Yeah. Commodities, they've rebounded. It seems like, but it's gold and silver and the precious metals. They're the ones that are off to the races, and they've had this exponential move. And usually when you see moves like this, it's market toppy. But if you look at gold, and you go back, and I was looking at gold before we got together, and in the late 70s, it had a big move up. It kind of fell down, and for like a decade plus, it kind of traded between $200 to $400. And then it had one of those parabolic moves, but it didn't stop. It didn't stop, and it kept moving for years and years and years. And so is this one of these blow-off tops, or do we have more room to run here in gold? Yeah, well, what you point out, too, is when we got off the gold standard, right, we had this movement, and then we had really the buildup of deficits. This is back in the Reagan era of deficits don't matter. Sound familiar? MMT, right? We give it a new name because we have to modernize it. That's probably one of the M's in the MMT. And so I think what you see is that
it's correlated essentially to the fiscal deficit, because we always look at the fiscal deficit being a big driver of devaluation of the currency. So when you print money, there's usually two things that happen. Either you get inflation and or you devalue the currency. And so what we're seeing here lately is somewhat of a devaluation of the dollar, but it's not as strong as people would think. It's heavily weighted to the euro today. So if you look at the dollar index, the Dixie, we call it DXY for the mnemonic, what that one is that's heavily weighted to the euro, and that's really what's seen as devaluation. Talking to some of our PMs, when they're talking about the global dynamic, you're not seeing the same thing in emerging market countries. They're not as strong right now. So it isn't this broad-based devaluation yet. I do think that these markets, the gold and silver, is a little ahead of itself. But I think if you see a pullback, it's worth buying on. This does remind me a lot of what we saw in the 11-12 experience, right? Yeah. Remember that? Remember back then there was cash for gold, but remember driving down through Venice or seeing the billboards, it was cash for silver, right? Yeah. Silver got
poor man's gold, and that's usually the danger zone when people are starting to get built up on silver, which has had a huge move recently.
Right. So Kenny Loggins in your danger zone, right? So exactly, as you look at this, what you see is that silver really started to catch it lately. And remember, silver got to around $50 an ounce back in that 11-12 experience, and it fell off very quickly too. The thing I would caution about adding to the gold or the silver positions today is because you've seen money flows dominate. Again, supply demand, as we talked about, the flows have been very heavy into gold, and then lately silver, but also net speculative length. So if you look at the commitment of traders data on the speculative side, it's pretty long. So usually those are contrarian signals. I don't know if I would read so much. I'm not a seller, so I own a little bit personally of gold, I meant to say. I'm not a seller, but I definitely have not been adding any position on that side because to me, it seems like it is a little ahead of itself. But when I look at the fiscal side of the equation, when I look at Congress, what they're going to do, they're going to devalue the currency one way or the other. Either it's going to cause some form of inflation, which I don't think it's inflationary today. So let me parse that thought. Because one, you talked about real yields being negative. If you look at TIPS, they continue to grind down. So that says that the market is not priced in growth. They think that it's going to be this type of environment. Secondly, what you've seen too on the inflation side is that this money printing isn't really stimulative. But yes, you kind of have a little wealth effect.
Stimulative for risk assets.
It's stimulative there, I would argue, but you're not getting this velocity of money, right? So you're not seeing it in goods and services. You're not seeing like iPhones fly off the shelf, TVs, jet skis. Remember what people were doing back in 05, 06 when they were cashing out of their house. So you're not seeing this big effect because a lot of people are unemployed, right? We have a huge unemployment rate. The continuing claims is somewhere in the 17 million persons today. Then you have the unemployment assistance, which, there's some nuances there, but, call it 10 million there. I mean, you have 27 million people likely unemployed today. And I say likely because we don't know if there's some double counting in the unemployment side. But what you see there is that those people, it's not like they got this stimulus money and they're like, oh, I need to go buy something. It's like, I need to pay my bills, right? And so that's why I don't really see there being this big velocity on that side. So I think they've ran a little bit ahead of yourself to answer your question. I think the precious metals are a little ahead of themselves. If you start seeing it leaking over to platinum and palladium too, then you'll know it's kind of the blow off. But so far, I think silver is just kind of catching up. So, yeah. But remember, as you call it, poor man's gold, it tends to be 2 to 2.5 times more volatile than gold prices. So for those that are saying, hey, I missed the gold rally, I expect silver to catch up, just be wary of that volatility aspect.
So you talked a little bit about the dollar. It's been pretty weak. It's dropped almost 10 points since its highs. It got almost to 103. Yeah. A lot of investors always ask me about, can rates stay low? And I say, yeah, they can stay low. Even with huge money printing and even with high deficits, if the Fed buys the bonds.
That's right.
And you've seen that happening. But I say it seems like that Ponzi scheme, not that it is a Ponzi scheme, but let's just call it what it is sometimes.
Fool's theory is a nice way of saying that.
Yeah, it seems like it can work as long as people believe in your currency, right? That's why we can do it. That's why Japan can do it. That's why Europe can do it. That's why Venezuela can't do it.
Yes.
Right? So it seems like MMT is possible as long as people believe in the dollar. And so, how long will that last? And so one thing I think about it is they're going to lose, the world will lose faith in currencies at the same time. It's not like the dollar is okay and then the yen, the dollar is not good, but the yen's okay and the euro is okay. I think if people decide that the dollar is not okay, they're probably going to say, I think all money's not okay, right?
Right, all fiat money is
And that's
not
why
okay.
that's why gold's up at $2,000.
Well, and it's not shocking that, the cryptocurrencies, they'd been around prior to the financial crisis, right? They caught wind around that time. They really started to get their runs going. Like, yeah, we saw the blow off, I think was it 17 or so, where, Bitcoin got close to like 20,000. I think it was 19.5 or something. But it's not shocking to me to see the cryptocurrencies moving similarly because it's the same crowd, right? That's what my argument was, is that the gold bugs, and again, no offense to the gold bugs out there, they have a point, but it shouldn't be your whole portfolio. But the reason for the cryptocurrency is the same kind of folks. They don't believe in this fiat system. They think the confidence will erode one day. The other benefits I'm not as convinced about. The anonymity of it, it's not anonymous. By definition, the blockchain tracks you. I mean, there's a reason the CIA and it goes after these gun runners and things that have trafficked to there. So, when I look at it, it's the confidence in the system. And, look, at the end of the day, banking is a confidence game. It's a fractional reserve system. But we do that to create velocity, and we do it to create the lending powers out there. So I think that the dollar's reserve stash is not in jeopardy today. It could be if we continue down this path. But remember, the other thing that a lot of people forget in the financial conversation is we are the world's military superpower. That has a lot of power in the reserve currency because guess what? You can do the helicopter money. There's a lot of stuff when you can protect it. Yeah. So I think those things are highly correlated. Remember, when the British pound was the reserve currency, they had the same thing. They had the military superpower. Yeah. So don't forget that point. Look, I'm not a warmonger or anything. I don't think that's the...
So the days of King Dollar are not over yet?
I don't think so. But...
Doesn't mean it can't weaken. Doesn't mean it can't weaken.
Right. And remember, when we've done QE, it tends to weaken, right? And we are doing QE. We're doing fiscal, in just very, very large amounts today. In droves is what I was going to say. But I just, at this point, I don't think the dollar collapses. It's not that it's going to be massive because, again, there still is something about the assets you buy with the dollar. Don't forget, financial assets in this country, there is this idea of safety in this country as well. We still are AAA rated. I know we got put on downgrade watch against.
AA, I thought.
Yeah, well, S&P. It just depends on which one you're looking at. I think Fitch actually put us on downgrade watch this over like either late last week or over the weekend. But look, it makes some sense. We got to get our fiscal house in order at some point. But I wouldn't be shocked to see at some point the Fed trying to adopt some sort of inflationary idea. I know there's criticism about the inflation target. Will we ever get there? But if we just say, look, we're going to keep printing money in a big amount, and guess what? Consumer, you need to go buy. Remember, Bush did that with the stimulus checks and when we went and invaded Iraq, right? It was that, here's a check. Go spend it. Don't save it. Go spend it. It's your American duty to do that. And remember also when Shinzo Abe, got elected, he ran on a platform of generating inflation in an area that did not want it, right? So remember, attitudes can shift. They don't shift overnight. They take time. But again, just to say it can't happen is something that I think is very dangerous.
Mm-hmm. All right. Well, why don't we kind of break it down into a bull bear scenario? Like, what's the bull case for markets? And then we'll go to the bear case.
Yeah, I mean, look, at this stage, you've made a lot of money in markets. Like, look, if you own the NASDAQ all year, you did I like to call it the Rip Van Winkle approach. You went to sleep, you woke up at the end of month 7, you're up 20%. You're like, what problem, right? There's still going to be winners in this market too. You see it in biotech. You see that area, like we look for a vaccine. There's a lot of excitement around that. Healthcare is still going to be needed. Regardless if we have a recession or not, people need to be treated. There's still pockets of the market that look okay. Valuation is a little stretched. When you see people trolling out charts that say, well, don't look at the forward 12-month PE. Look at the 24-month or the 36-month PE. Heck, why not look at the 100-year PE? If you're going to do that. So, but at this stage, like the fiscal side, what I really worry about right now is that we have so much fiscal stimulus, but we don't have the true economic jobs. So we don't have the productivity there. We don't have people contributing more to society. And I think that's really the next leg of the bull market's going to need that. So look, even if it pulls back a little bit here, you still want to own risk in the long run, especially with the relative valuation of treasuries. But again, there's nothing wrong with owning a little bit of cash if you're wrong. Remember, cash is good in down markets. You can buy more. We saw that, right? So ultimately, the bull case, I think, really stems down to not the economy right now. It's all about the fiscal programs that are going to come through. Monetary support's going to be there. The Fed has told you that. But remember, the Fed can't engineer the economy. They've done a lot of what they can. They can buy risk assets, but buying risk assets doesn't do anything for the efficiency of the economy.
So we need fiscal. We really need to see what happens with the fiscal response. And it almost seems like the worse the virus news is, the more aggressive the fiscal response can be, and potentially that's part of the bull case.
That's part of the bull case, and that's the thing. Like if you overlay the virus and the cases, you're not going to find any correlation there. You saw it to the downside initially, but that's went away because exactly that case you're making is that there will be support, and it will encourage our policymakers to do more. But that said, what happens when they're not there?
And that's the bear case.
That's the bear case. And so, we just talked about this at our asset allocation meeting last week at the end of the month. And, it's like, look, there's really no catalyst right now for things to fall apart. The economy is where it's at. The unemployment rate is where it's at. We've all had eyes on, can Congress get together to help a package to get checks in people's hands right now, especially the unemployed. And, look, we can argue the merits that the moral hazard they created, but we already started it. We need to continue it, or you're going to have another wave of unemployment that's going to follow on suit. It's going to be much worse. So either we agree that, at this stage, we need to just get the economy back.
There's no turning back.
There's no turning back. We need to change. Look, I'm worried. Like I use, people that follow our stuff know I use a lot of baseball metaphors. And like, I watch baseball right now, MLB. I mean, they're getting cases left and right. You have whole teams catching cases, 10 to 15 players per team. If grown men who make a lot of money get together and these 40 or 50 guys together can't figure out how to protect themselves,
how's everyone else?
How's your children going to go to? How are your children going to go to school? So we got to do something. And look, I don't know if herd immunity. I'm not an epidemiologist. I'm not a scientist. I don't know any of that. What I do know is whatever we're doing right now is not working.
Yeah.
And until we can figure that out, the government's job is to provide a support. That's why we pay tax. We do stuff. But what I'd like to see in the spending programs is I like to see stuff that has a good money multiplier. That's not popular, right? But you put it in lower income hands, they do spend it, right? That's by definition, they live paycheck to paycheck. So they will spend it. So, it needs to be targeted. We don't need a payroll tax cut. We don't need these other things.
Get the money into the hands of the consumer.
Yep, exactly. And let people survive, because you know what? They'll be thankful when things come back. When you can hire them, they will work. That's the American spirit. People want to work. Let's
send on this positive note.
Absolutely. Yeah. Look, there's some good sides. So at the end of it, I think, right now you're talking about asset allocation, bull bear case. Like, I just don't see this bear scenario happening overnight, right? We had an exogenous event. It hit. We know that now. But what can happen here, people can lose faith, right? You said confidence is there. We lose faith in the Fed. We lose faith in policymakers. I mean, they announced today they're probably not going to get a deal done this week, right? Those things can start to erode. So I don't think you see a precipitous drop even in a bear case. It's going to start to build. And so those are the things to watch today.
Okay. All right. Well, we got some questions from the audience, so let's take a look at that next. All right, so here's number 5 question here. If you wrote an autobiography today, what would be your favorite chapter? Not 2020.
Yeah. No, that's not going to make the book. My favorite chapter would be the DoubleLine experience. I mean, we talk about it a lot. Hands down, taking the risk, starting the firm, working together, all of us, the camaraderie we built, that would be my favorite chapter, hands down. I mean, the experiences we had, the stories we have. I mean, we were reliving this recently as we've been trying to create some cultural events, especially for new employees. And yesterday we were telling stories back and forth, and all of a sudden we spent 2 hours after work just sharing stories. And to me, that's one of the greatest experiences of my career, is doing that. And
it's almost like these volatile times kind of you bond more during these volatile times. Like, we were on the road for years, kind of not being as close, and this whole kind of fiasco brought everybody back together to get through these tough times. So
absolutely. And the words overused is adversity. I don't think we overcame adversity here. I think we did our jobs. And also, you remember why we all work together, right? We value each other's opinion. There's dark times. I remember when the mortgage REITs were blowing up, talking to you, talking to Morris.
Those were dark times.
I mean, they were dark times. I mean, we were having calls on the weekends, and we're talking about what to do for our levered accounts and stuff like that. And look, you have to get through it. And no, that's probably my favorite. If I had to write the autobiography, I'm not a good writer, so I'm not going to do it.
We'll have someone else write it for you.
Yeah, ghost writers, right?
All right. So number 4, with the COVID lockdowns, what do you miss the most? Human interaction, right?
Yeah, I guess just normalcy.
It's amazing what you take for granted. It's just, if we could just go hang out with friends and have a beer. Yeah. I was joking with Morris, who I traveled with a lot, and I said, remember that crappy airport bar in where was it? In New Orleans. No, it was Baton Rouge. I'm like, if we could just be sitting there together, having a Bud Light, getting on a plane, even if it was delayed. I mean, just to do something normal and out of the house and kind of back to what things used to be like. I think you take a lot of that for granted, right?
No, absolutely. And you forget what your life was like pre-COVID, right? At this stage, right? The things that you do take for granted, and a lot of it is just the day to day, right? We've been locked in our houses.
Just driving here was a nice, pleasant. I got to listen to the radio, listen to music. I don't have time for that right now.
Yeah, no, I agree. And I know I listened to a lot more podcasts at that point too. I use the car as a place to do that. So I think what I miss is just seeing everybody too. Like I remember how good it is to come into the office, and that's why we like our jobs. We like to come here. It's one thing to talk markets, but I know even with our team doing our little Zoom or team meetings about trying to have a little happy hour, it's just not the same.
It's not the same.
Yeah, it's not at all. Like still somebody's kid crying in the background. There's still a thing. So just living. I think
that's why I think like 60% of people survey, they want to come back to the office, right? And it's for even with a commute. I have a long commute, but I want to come back into like the business center and feel that vibrance. So hopefully things will be back to normal in hopefully in at least 6 months. Number 3, an owner tends to look like her dog. What dog? Wait for you, a cat. Because you want a cat. What dog would you? Your hair kind of looks like a cat sometimes, right?
Wow.
What dog would you say looks like Trump Biden?
The hybrid of the two? No, I have
Trump
no
and
idea.
Biden.
I mean, I think I'll attribute this to like Bill Maher, but he said that Trump looked more like an orangutan because of his orange skin and everything. But I really don't know. I mean, I'm trying to put the hair on a dog.
Maybe Trump looks like a terrier, a terrier with his.
Yeah. I don't know. And then Biden, he's got to just be, regardless, he's got to be like a Shar-Pei, like an old senior Shar-Pei.
He's like an English bulldog.
I don't know. I'm not good enough. I'm gonna have to say I'm not good at that one. But
number 2, what do you think of Fauci's first pitch starting out this disastrous baseball season?
Disastrous baseball season. It was a disastrous first pitch. He set the tone, right? I did read on Twitter, I'm not going to take credit for it, was the reason he did throw that. He doesn't want anyone to catch anything, right? But look, the hype, he didn't have time to practice. I guess he's too busy. But I do think that's the reason President Trump reneged on throwing out the first pitch at a Yankees game. I don't even know if he's invited. He claimed he was.
He probably can't make it to the...
He was just like, dude, there's no upside to that. Like, throwing out the first pitch, it sounds awesome. But think about the pressure out there. You're trying to do it. Everybody's watching.
Didn't GW,
he threw a heater, man.
Yeah.
Did
he?
Yeah, no.
He used to play ball, right?
Yeah. President George W. Bush, he actually threw a perfect strike in a playoff first pitch. So, you can criticize Bush for a lot, but he always seemed like a guy you want to have a beer with. And look, if I need a first pitch, I'm calling him over Fauci.
All right. And number 1 question from the audience. Which grows faster, Steve Mnuchin's 5 o'clock shadow or Trump's hair?
Got to be the 5 o'clock shadow. I mean, Trump's hair, does it grow?
Is it real?
Is it? I don't know, man. There's a lot of political hate on these people today, but I just don't know. I mean, Mnuchin, he does always look like he needs a shave, right? But who are we to criticize? We've had beards for a long time.
That's right. All right, well, thanks for coming in.
Yeah, well, thanks for having
me. I know
you
have a lot of podcasts, and this was your chance to come in and tell everybody what you think about the markets. So I appreciate it.
Yeah, no, and good luck with your Channel 11 news show.
Okay,
here.
thank you.
Right, thanks, Ken.
Thanks, everyone.